Let's continue that conversation with Jefferies Chief Market Strategist David Zervos. David, good to see you.
Good to see you, Carl.
I wonder how much weight you're putting on this phone call and whether or not that really gets the needle moving before we see some of that bleed through to hard data.
You know what, Carl? I think the needle is moving. It's been moving. This has been a tactical trade negotiation from the beginning. And I think where a lot of folks got twisted up is they took the opening gambit as a literal move and said, oh, this is where we're going to end up, which was really a worst case scenario. It was an attempt to drive people to the table in a negotiation, and the table is set. And we are seeing lots of folks from all over the world coming to that table and resetting the trade structure so that many of these imbalances that have been in place for decades get reset, much like they were reset in the 1980s during the Plaza Accord time in the mid-1980s, 1985, in fact. And that's kind of a narrative that we're using with our clients, that this is very similar to the trade negotiations that really centered more in the end on currency markets than they did on tariffs.
Right. But you're right. The market was sort of set up with a certain number of promises. Navarro, 90 deals in 90 days. I think it's been 52 days since he said that. I wonder whether or not you think there's a danger in some of these people across the table sort of rope-a-doping and slow-going these talks.
Certainly. I mean, we saw the Europeans going slow. We saw the president push back. Then we saw them come back in, and everything seems to go back to a negotiation. I think we just have to look at this, Carl, as a storyline that is a negotiation tactic. This is how our president operates. It's different than past presidents. It's different than most past policymakers sitting in trade negotiation seats. But the idea is to end up in a fairer, more balanced trading environment. That's why I find all these forecasts, whether it's the Fed, the OECD, that are focusing on inflation or growth hits. Why? Why do that? This could end up actually very positive, and you should have that probability weight in your economic forecast just as well. I think it's a mistake by many to assume the worst, that everything goes to a less fair or less congruous trading environment. We could go cooperative. We could go to a much more cooperative trading environment when all this is said and done. That's the goal.
I feel like that's what the equity market, David, is increasingly telling us. We're 3.5% off the highs on the S&P and 23% off the lows in the S&P. So at this point, it's kind of a glass half full approach. What needs to fall into place economically and from an earnings perspective to have that happen? Because there are still risks, right, as you change the cost structure of business, that there's going to be side effects.
Sure. And every one of these businesses is fantastic at risk managing. That's what they do for a living. These CEOs have many shocks, not just trade, but shocks all across their businesses to manage. And that's what they do for a living. That's why they get paid. And they'll continue to do that. Look, sir, we've got deregulation to get excited about. We've got a tax bill to get excited about, tax cut and job growth, tax changes that are going to be pretty significant. And we have a whole set of monetary policy changes that I think are going to be coming down the pike sooner rather than later that probably ease up financial conditions as we realize this was much more of a negotiating tactic and less inflationary than many people had thought. So there's just a lot of policy on the horizon that to me looks very positive for equity.